Yes, sir. Uh, Good evening, everyone. I am C.A. Sagar Garg, Chairman of Dhule branch of WLC of ICI. Today, I am moderator for this webinar. We are delighted to welcome you all in this webinar being organized by Continuing Professional Education, that is CP Committee of ICI. It is my pleasure to be a moderator for this webinar on analysis of financial statements for investing and value of supply under GST. In a short while, we will start this webinar. First, I would like to apprise you about a CP committee. The profession of a chartered accountancy is growing leaps and bounds, and its phenomenal growth has brought the profession at forefront. Today, our profession has acquired an indispensable position in the business and economy. I have continuously, ICI continuously aims at developing knowledge age so that the members stand out to the expectation of the society. To achieve this objective, the CP committee of ICI has been continuously striving for perfection, integrity, and knowledge, which make the word chartered accountant synonyms with excellence in service. In this direction, CP committee has always been proactive to the emerging needs of its members, enabling them to acquire contemporary knowledge and skills to face the challenges effectively by organizing CP programs and providing adequate opportunities. Today we have two programs, two sessions. First is the financial statement analysis for value investing, and another is value of supply under GST. We have with us a chairman of CP committee, Sri CA Purushottam Khandelwal sir. He is the chairman of CP committee and convener of RBA Directorate of ICI. He is having 25 years post-qualification experience in the field of audit, direct and indirect taxes, and intellectual property rights. This year, he is devoted to fortifying CPE framework and guaranteeing quality across its entire operational spectrum. And this year, major focus would be on upgrading of CPE portal for enhancement of the branding and professional competency of members. So I welcome CA Purushottam Khandelwal sir. I request sir to please present a welcome address.
Good afternoon,
Okay.
respected faculty for the first session and my dear friend Shilpang Karyaji, second faculty and also my dear friends Hiren Pathak, moderator of this webinar, CA Sagar Garg, chairman of the Dhule branch, team of the CP committee and respected members. It gives immense pleasure to be amongst you on the occasion of this webinar. The CP committee is a mother of all committee, and my committee and team CP dedicated to update the knowledge of the members at large, because what we are selling, member is selling services. We are not selling any product. So when we are providing services, it's a mandatory that members should be updated to the subject. Because the Nani Palkiwala rightly said, before giving advice to anyone, you have to refer the books before giving the advice. Because the information which you have may be irrelevant today, which was relevant yesterday. So member has to take a care before giving services to the clients. This year, my committee is dedicated to organize various seminar, conference, workshop. Last year, we have invited a finance minister, Nirmala Sitharamanji, at Bhubaneswar on these platforms. We have invited Yogi Adityanathji at Gorakhpur on this CP committee programs. And in Gujarat, we have invited Chief Minister Bhupendra Patelji and many more across the country. One thing is very important, that member, those who are non-compliant with CP, what I say I can do, member always say me. This year, we come out with the guidelines, which is approved by the council, that member, those who are not voluntary compliance to CP our requirement, we have given a 4 phase. what action can be taken by the ICI. First of all, those who are not compliant of the CP hours, they have to double in next CP calendar, next 6 months. Even they are not compliant, the name will be published in the ICI website. Still they are not compliant, we may advise to peer review board that the provisional certificate should be issued. So no final certificate issue, and you know that 5 or more partners, it is compulsory from this 30th June, your firm should be peer review. 4 or more partners, the last date of compliance of peer review board is 31st December. So my humble request to my respected members, please comply with the CPA requirements. The 4 hour you can learning through digital learning hub. There is lot of material available in the DHL learning hub. So please take a benefit of that. I will not take much of time. Silpang Karyaji is here to take the first technical session. Thank you, Sagar bhai, for giving me an opportunity. Thank you so much.
Thank you so much, sir. Uh, this committee has vice chairman, CA Gyan Chandra Mishra, sir. Mohiji, sir is here or not?
I think नहीं है सागर जी.
Okay,
ज्ञान भाई
okay, we will move forward. Uh, First session will be on value financial statements analysis for value investing. So this session will be presented by CA Shilpang Karya sir. He has more than 2 decades of professional experience in valuation practice, primarily as transaction advisory, mergers and acquisition valuation, pre-IPO and post-IPO placement valuation. He has been working as a corporate advisor, registered valuer, and advisor to IPO for multinational company and startups. He has also delivered various lectures at different forums on SME IPOs and valuation. I request sir to start his deliberation. Thank you so much, sir.
Thank you very much. First of all, good afternoon to all the members. And let me convey my thanks to the CP committee, Chairman Sri Purushottam Khandelwal ji, Sri Gyan Prasad Sarma ji, for inviting me for the cause of our ICI members. And for the ICI members, we will be always ready, and we'll be very pleased to address to our ICI members, because we are here because of our ICI members. So it is our privilege to come in this platform and to share our whatever little knowledge we have. So first, let me start with that thanks. And now, should I start the presentation? Okay. My screen is visible. Yes, friends. So topic today given to me is a financial statement analysis for the value investing. The financial statement, it is very immensely important document for we all chartered accountants. We all chartered accountants learn the financial statement. We deal the financial statement starting from our student days, day in, day out. All chartered accountants in whichever field, maybe associated with the tax, maybe associated with the stock exchange, listing, GST, income tax, ROC, whatever practice they do, the core document which they need to address is a financial statement. Every practice is all and around the financial statements. But today, our topic given to me is a financial statement analysis for the value investing. That is from the investor aspects and from the investee aspects. So chartered accountants and our friends who are into this field from investor and investee aspects, I will share my knowledge that how we should, as a valuer, we should address the financial statement analysis. Maybe we may be representing the investor side, we may be representing the investee side, but the how we should analyze the financial statement so we can create the wealth for the investors. So I will divide my presentation into the 5 parts: valuation, investment and valuation truth. financial statement analysis, financial ratio analysis, how to analyze the each head of the financial statement, and discussion on the ratio analysis of the few practical cases. So given the, if time permits, time given to me is of 1 hour. So whatever I can cover within 1 hour, I will try to deliver. So when we say the valuation is art and science both. And basically, it may be more art in certain cases, it may be more science in certain cases. It depends upon certain circumstances, purpose for which you are carrying out the valuation. But in our case, when we are addressing how we should analyze the financial statement from the investor angles, from investee angles, at that time, I will personally say that valuation is a art. And when we say the valuation is a art, then at that time, we should refer the truth given by the successful investor and successful investee, because ultimately they will guide us how to analyze the financial statement. Their statement will give us the insight. We as a chartered accountant definitely know how to prepare the financial statement. We don't require any guidance on how to prepare the financial statement, but how to analyze the financial statement with our purpose of the value investing. Definitely we should go into the insights given by the successful investor and successful valuer. So James Ichner, one of the greatest valuation advisor of the USA, what he has said, value is a future looking investor by tomorrow's cash flow and not yesterday and not even 2 days. By this statement, he defined two things. First of all, when you analyze any financial statement, it is not about the what financial statement is of worth today. But as an investor, you should be able to analyze the financial statement for the future purpose, means whether those financial statements are going to give is the return in the future or not. Number one. And number two, what is important for the investor is a cash flow. Whatever may be the profit in the future, but ultimately, if it doesn't generate the cash flow for the investor, then definitely it is not of worth. So whenever we analyze any financial statement, we should be able to visualize the future out of it. Actually, the analysis start from the financial statement, but it is not end. Financial statement is only the starting point of analyzing. Ultimately, thereafter, we have to take the 360-degree view. It is from the financial statement analysis, we'll be only able to know where we need to go, where we need to open the door, where we need to open the window, and that will guide you to visualize the future from those financial statements. Accordingly, again, James Sichner said, the past performance is only relative to the extent that is indicative of the future performance. Means financial statement, to what extent we should rely on the financial statement, it is to the extent only we can get the value, we can visualize the future out of it. So financial statement, utility of the financial statement is defined at this stage. Now, when we invest into any company, I will say it is a trade-off between price and value. So as a expert, as a financial expert, we as a chartered accountant should be able to get two things from those financial statements. What is price and what is value? Price is visible, value is not visible. Value as an expert, we should be able to analyze. So we need to analyze the value out of those financial statements. Price is the visible, means there is a price. Investor and investee come on one price. They will negotiate one price. But as an expert, you should be able to visualize the value out of it. And whatever the maximum value you will get out of it, or we can say how much negotiated price you can close from it. Whenever there is a much difference between the price and value, it is a success. So as a buyer, yes, value we are able to visualize as on date. But actually, whatever value we visualize, it true or false, we will be able to know into the future only. So what is the buyer success? Value minus price. And what is the seller success? Price minus value. So Warren Buffett, who doesn't know, everybody knows the Warren Buffett. So I am going to produce certain truth given by the Warren Buffett, because he is one of the richest person and richest investor who day in day out advise about the investment, and his truth and his sentence given by the given for the investment advice are considered the most valuable investment advice across the globe. So he has said, It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. So by this statement, what Warren Buffett says, whenever you invest into the company, just don't look into the price, whether it is a cheap or whether it is a highly priced. Only what is the valuation. You should not look into the what is the valuation of the company at first instance. You should look whether the company is wonderful or not. If the company is wonderful, then definitely the price and any other aspects is overvalued or undervalued are the secondary aspects. First and foremost aspects as an investor you should see is whether company is a wonderful or not. Again, Warren Buffett says, I am a better investor because I am a businessman, and I'm a better businessman because I'm investor. So by this statement, he says, as a financial analyst, it is not sufficient that you should have only the knowledge of the financial statement. You should not have only the knowledge of the figures, and your capability should not be restricted to analysis of those financials. Your capability should be to analyze and visualize the business aspects. If you can visualize and analyze the business aspects, you should put yourself as competent as the businessman and promoter, then and then only you will be able to analyze the business aspects and you can analyze the value out of that. So again, he has said, unless you are willing to put efforts to learn the accounting, how to read, interpret the financial statement, you really shouldn't select the stock of yourself. Let me again clarify that this fundamental analysis right now we are discussing is we should not compare it 100% and only with the stock market aspect, because stock market aspects valuation are made of two things. It is not only a fundamental analysis. Yes, fundamental analysis is a greatest important, extreme important while you invest into any stock, but stock market analysis is also consist of the sentiments. There may be a certain company who may be fundamentally strong, but sentiment and any other aspects which go against that company, so it will not, their price will not reflect into that valuation, even the company is a fundamental strong. So Warren Buffett has said, whenever you invest into any company, you should have skill set to analyze an financial statement. If you don't have that skill set, but I can't say we chartered accountant has the skill set, but we could not have the time to analyze those financial statements. So if we cannot appropriate the proper time to analyze those financial statements, then we should not select the stock at ourselves. Warren Buffett has given the investment principles. What are that investment principles? So in chronological order, if we say, first and foremost is we should understand the business. We should invest only if we understand the business. There are many investors who are focused to certain business verticals. They say, yes, I analyze the business analyst, stock analyst. They are saying that I analyze the business of these 5 verticals, and definitely they get the 360-degree view of those business. They know about those business equivalent to promoter and even more than promoter. So whenever we want to invest into any stock, we should understand the business. If we don't understand the business dynamics, then we should not invest into that business. Another aspect is we should be able to see the long-term prospects of that business. If there are not long-term prospects of the business about their earning power, good return, debt, what is the key drivers of the business. So if we are able to visualize the prospect of the business, then and then only we should invest into that business. So second aspect is we should be able to visualize the prospect. Third important aspect, there should be honest and competent managers, means promoters. If the promoters and managers are not honest and competent, means then there is no meaning to invest into that company, because whatever may be the competent promoters, if their integrity is not there, then definitely our money is at risk. And competent is also important. Whatever may be the honest promoters, but if they are not competent, then there is also no meaning. Certain time investors are saying that we are investing into the promoters, not business. So promoters who run the business is also a very important analysis before we jump into the financials. The first 3 part, what I have said, it is not related to any financials. It is generalized. But very important before we actually analyze the valuation based on the financial. And at fourth point, he says the valuation come into the picture. Valuation is attractive or not attractive in terms of the investors. Mean if we are getting the valuation is a higher and price is a cheaper, then definitely we can say valuation is a attractive for us. Now, for financial statement analysis, I have put certain key aspect. As an analyst, what we should analyze, what we should see in the financial statement, and on what basis we can analyze it is a correctly valued, highly valued, or cheaper valued. So when you have any financial statement in your hand, what you should see before you jump into the financial figures, you should know the industries. As rightly Warren Buffett has said, we should put ourselves as a businessman. If we understand the industry's dynamics, then only we should think of investing into the companies. Then another most important is a promoters. If we rely that yes, promoter is a reliable, promoter is a integrity, promoter is a competent, promoter history is that we can trust the promoter, investor can trust the promoters, then and then only the company should we should invest as investor, we should invest into any company. Thereafter, obviously the business model of the company itself. And nowadays, we can also that auditor is also extremely important, because the auditor who prepare the financial statement, who certify the financial statement, so a certain time the reliability and trustability of those figures are based on the auditor's credential, auditor credibility. And as an investor doesn't go into the correctness of those figures. Investor can analyze the financial statement by considering that the figure produced in the financial statement are correct, and those things depend upon the credibility of the auditor also. Now, after we analyzing all this general thing, what we should see, we as an investor first of all identify what is the key valuation driver of any business, because any business are depend on certain key valuation drivers. That key drivers drive the business. We should identify what are those drivers. Those drivers can be the sales locations, order on hand, locational advantages, number of customers, scalability due to the IT, branding, brand ambassador, list. List can be exhaustive. It is just an indicative I am referring. So why we should identify the key valuation drivers? Because the future profitability of those business depend upon those key valuation drivers. So you first of all identify, put in paper and with paper and pen that what is the key valuation drivers in this company, which factor drive this business. Why that is very important? Because tomorrow anything will happen to those business aspects, those valuation driver aspects, then how it will affect the financials. Certain time it happens that even 2 to 5% variation into those key valuation drivers, company will be converted from profit to the loss. Their cash flow will become the negative. So analysis of the entire financials and sensitivity of the key valuation drivers with our profitability and cash flow, it is a very important analysis. Thereafter, most important is like a valuation driver, another important is a competitive advantage. Today, the company may be having a certain competitive advantage, but it cannot be a sustainable for the lifelong. Competitive advantage may be the lower cost, greater size, intangible assets. So many things could be considered as a competent advantage over their competitor. But today, what we consider as a competitive advantage, and we invest considering those competitive advantage, but tomorrow those competitive advantage may not sustain for us. So we should be able to visualize that whether on what competitive advantage we are investing, whether they are going to sustain in the future or not, or to what extent we should take the risk on those competitive advantage. Now, after analyzing all these general things, now let we come on to the financial statement. So when we reach into the financial statement, first and foremost thing we should do is a normalization of the financial statement. Because the financial statement, if you refer any historical financial statement of 1 year, 2 year, or 3 year, the profit may be subject to certain another factor which may not be sustainable into the future also. It may be abnormal income. It may be exceptional income. It may be income due to certain exceptional order received in 1 year, which is not going to be received in future, or we don't know it will be received in the future or not. So because value is a future looking, we always say value is a future looking. So in future, the profit which is being reflected into the financial statement are going to be continue in the future or not. Those aspects we should be able to analyze. Another aspect should be analyzed in normalization is a core business activity. We should consider the profitability and cash flow of the core business activity, because as an investor, we know that we are going to invest in, so suppose company is carrying out the 2 to 3 business activity. Company is into the pharma, company is into the real estate or any other business. But as an investor, you know that we are interested into the pharma business. If there is any profit from the real estate business, which may be 10% or 20%, we should ignore that. We should not consider into the EBITDA if we consider the EBITDA multiple, because as an investor, we are analyzing the core business activity in which we want to invest. And those separate item like a real estate or everything, it is like a surplus profit or surplus assets if we analyze the valuations of the company. Another most important aspect is to know the CAGR of the company vis-a-vis industries, because every industry has own dynamics. They have own economic analysis of that company or that industries, the market where they cater. Suppose the company is catering to the specific domestic market or specific export market. In export market, they may be catering to the certain country. And if that country has a certain risk factor for the future, then definitely our business would be highly affected. So we should be able to analyze. And if company is putting a certain expected business performance, as say is the 20% or 30% and 40% growth, and if it is not backed by certain reliable assumptions, then we should be able to see critically that if industry is growing at 10 to 20%, and why the promoter is saying that we will be progressing to up to 30 to 40%. So we should be able to analyze the expected performance of the business vis-a-vis the industries and the peer group companies. Working capital. It is rightly said, the promoter who can manage the working capital facilities efficiently can manage the business and can generate the profits. Because on day in, day out, once the capital is invested, once the capex is invested, it is the success in the working capital which generates the profit and which generates the cash flow. So analyzing the working capital cycle of any company is very important. It is not necessary that in terms of the banking sector, if we say 90 days working cycle should not be applied in this case, because every industry has their own working capital cycle. Certain industries would, by itself, the industry and business dynamics itself demands the more working capital cycle. So we can't ignore that why their working capital cycle is a longer. We need to analyze the working capital cycle vis-a-vis the peer and vis-a-vis the industries. So we should understand the working capital cycle vis-a-vis the sales turnover it generates, and incremental sales turnover it is expected to generate. So operating cycle and working capital cycle, very important aspects to understand that whether it creates the value or not. If with every incremental working capital, every incremental revenue, if the company is putting more and more into the working capital rather than generating the cash flow out of it, then definitely those businesses is a risk. So whether the ultimately at the end of the day, for the promoters, for the investor, what is important is a cash flow generating capacity of any business. And cash flow is generated only and only if the working capital is efficiently managed as per the industrial and business dynamics. Thereafter, another important ratio is a capex to turnover. So if we analyze the debit side of the balance sheet, broadly we can say there are two types of investment. One is the non-current assets and another is the current assets. So as a current assets, we analyze as a working capital cycle and as a capex. So there may be certain company who is a capital intensive, or there is a certain company who may be working capital intensive. So working capital industry may be capital intensive or working capital intensive, but purpose and objective of the both is to generate the turnover. Ultimately, why to generate the turnover? Because the generate the margin out of it. We can pay for the capex, we can pay for the working capital only out of the margin we generate from the turnover. So we should be able to analyze working capital to turnover and working capital capex to turnover of that business vis-a-vis a peer company and vis-a-vis the industries. Now, another aspect is a capex addition to the business plan. Whatever may be the profitability of the company as on date, but for investor, what is important? Future value is generated from the future. Now, suppose if it is a capital intensive industries and company is not incurring or not having any business plan to incur the capex into the future, then how it will grow the business, how it will grow their turnover. So capex addition plan as a business plan should be also understood whether company has those plans or not. If the company has those plans, from where they will fund those capex addition, whether companies financials and ratings are competent enough to generate the capital required for the capex addition. That capital required may be funded through debt or equity, anything, but company should have good rating to generate those fund required for their future business expansion. Another aspect is a excess assets or the assets deficiency. Now, from where we generate the profit? We generate the profit from efficient utilization of our assets. From efficient utilization of the assets gives the turnover to the company, gives the margin to the company. So as we know, there are many aspects of the assets. It can be current, it can be non-current, it can be tangible, it can be non-tangible, it can be investment. But ultimately, what is important? Efficient utilization of those assets vis-a-vis benchmark for the industries. So return on capital employed, most important aspect as a key value driver is what is important is a return on capital employed. What is our capital for us? We may say debt and equity if we see from the perspective of the credit side of the balance sheet, and if we see from the perspective of the debit side of the balance sheet, we can say the efficient utilization of those assets. So it can generate the maximum return on capital employed and return on equity for the investors. Return on capital and the proportion of its profits the company invest into the growth. So like we understood for the capex addition, we can also that company from the return on capital return on ROC, the company earns the ROC, it should have the free cash flow for the future growth. Definitely company can't grow the business with 100% debt. Company should have own internal cash accruals. Company also can't dilute their equity in the future at every expansion they need. So company should be able to generate own cash flow also. Because if company is able to generate own cash flow, then there will be also availability of the matching equity, matching debt. And what should be the debt equity ratio depends upon the company to company. But ultimately, for we require the fund for the expansion, and that fund for the expansion is available from the cash flow, and it is company should be able to generate the internal cash accruals and that those internal cash accruals should be deployed for the future business expansion. Capital structuring is extremely important. As a chartered accountant, we should be able to leverage, we should guide our client on the financial leveraging, that how debt and equity should be deployed, that company can maximize the margin for their investors as a return on equity. So what another important aspect is what amount of debts company should borrow. Definitely it depends upon company to company, but in general, if we analyze, then we should be able to identify the margin of safety. What is the margin of safety? Is the actual minus break even. Suppose in whatever worst circumstances in the future, we should be able to analyze. Let's we see the historical financial statement of this company, historically of these of the industries, and let we understand the business cycle of any company or any industry. If we understand any business cycle, and if we understand previous 10-year cycle of any business, and if we come to conclusion that in any worst circumstances, business can go down by 20% or 30%. So like as a cushion, if we say, let we take a cushion of 40%. And if business can go down in worse circumstances by 40%, then the whether company would be able to incur their fixed cost in terms of their operating and financial cost. So companies should be able to should borrow by considering those margin of safety factors. Very another important aspect is a interest coverage ratio. Why interest coverage ratio is important? Because it is EBIT to interest. What is EBIT? EBIT is a return on capital for the entire business as a whole. Because return capital may be employed in many different ways, as a debt, as a equity, or it may be deployed in different type of assets. But when we have EBIT, after incurring all our operating expenditure, what is available to is that is EBIT. And after EBIT, what is a fixed expenditure we need to incur is the interest cost. So we can say difference between EBIT to interest is also a margin of safety, because we should be in any worse circumstances, our EBIT should be able to incur the interest expenditure, and whatever difference is available is a margin for the return on equity, and ROE differential ROC we can calculate the return on equity and valuation on basis of the ROE available to the investors. Cash flow statement. Cash flow statement, extremely important statement. It not as an analyst, when we approach any analyst, they don't look into the profit and loss. They don't look into the any balance sheet. First and foremost page they will open and they will analyze is a cash flow analysis. Because if company is able to grow at whatever extent, but if company is putting more and more money into the working capital or capex with every growth in the business, then definitely company is not generating the cash flow. So rather than generating, it may also happen that company would be required to borrow more money to pay the old borrowing. So if company is consuming the cash rather than generating the cash, so those analysis is possible to visualize on the basis of the cash flow analysis, and certain time it may happen that the expert analyst only on the basis of the cash flow analysis conveys to the investor, no, I am not interested to invest into your company. Another aspect is a investment ratio. So as we understand that growth of the company depends on the how much you invest for the future. But that investment, if investment ratio is more than 1, it suggests that you are consuming fund more than what you generate. So you need to understand the investment ratio, your financing from those investment, your dividend payout ratio. Definitely, if your investment ratio is more than 1 and even the company is paying the dividend, then we may conclude that the company is borrowing money to pay the dividend. After all, investors are not interested into the dividend, and investors are interested in the valuation growth. So what investor will wish that company invest for the future if the company is able to generate the future business out of it. Now, we as a financial analyst should put our financial statement of any company we analyze as a comparative analysis, as a horizontal, vertical, trend analysis, like we learned from our student days. But it is not only those statistical analysis, but how we analyze and what we get out of those analysis, that is very important when we see it as from a valuation angles. As a sales growth rate, because we should not be impressed when we say the company has grown from 100 crore to 150 crore from year 1 to year 2. No, that is not important. We should be able to visualize that those sales. We should drop down the analysis to growth. Growth is due to the quantitative growth or sales price growth, because sales price may be subject to certain short-term situation and it may not sustain into the future. So definitely, what is more important is a quantitative growth. Second most important is the operating after the sales, what comes into the operating profit margin. So whether company is able to generate the appropriate operating profit margin or not. So EBIT margin, or if we say the case operating margin, so EBITDA margin. Third important aspect is we should put our key valuation driver with the cash flow. because as we understood that any business, growth of any business is dependent on their key valuation driver. Anything which negatively impact the key valuation driver will affect that cash flow, profit, and in turn cash flow also. So we should analyze and put the sensitivity analysis. If something happens, if we put down our key valuation driver by -5%, +5%, -10%, +10%, and thereafter how our cash flow and profit will be reflected and impacted on those aspects should be analyzed. Definitely working capital and capex is extremely important, and we should understand the incremental working capital requirement with the incremental sales and incremental capex required with the incremental sales. So as we discussed in previous slide, that we should be able to analyze the asset side of the balance sheet in depth. Why asset side of the balance sheet in depth? Because your efficient utilization of the assets only is able to generate the profit. So as an investor, we should analyze certain aspect of the asset side, like increasing inventory vis-a-vis sales. If the sales is inventory is increasing faster rate than the sales is increasing, definitely it's we should see it as a cautiously, and we should analyze the reasons behind that. Obsolete and slow moving, non-moving stock valuation methodology adopted also should be seen, because any wrong methodology adopted will reflect the stock valuation on higher side, and in turn the profitability on higher side. Longer period receivable, expected credit loss, because certain time it may happen that there is expected credit loss, but it has not been provided since long. So if it would have been provided, then what could have been the balance sheet situation should be analyzed. So longer period receivables should, even as a from valuation aspect, we should put apart the longer period receivable, and we should see if those receivables are not received, because valuer and analyst will analyze all financial and situation as a worst circumstances. If in worst circumstances this thing happens, then what would be the case with the company? So even in those worst circumstances, if company is able to sustain in the better manner, then it will become a good case for the investor to invest. All those aspects should be, whatever aspects we are discussing should be analyzed vis-a-vis financial statement only. Longer period capital work in progress, because longer the capital work in progress will definitely delay their not only the project execution, it is not only a risk of our fund, but it is also a interest cost involved behind it. Litigated assets, suppose company has a business, their key valuation drivers is suppose certain showroom. Company is generating the business from certain showroom only. And if their showroom is situated at place where company is having any litigation, so if in future those litigation will go against the company, then definitely company's entire revenue would be affected. So definitely we should be able to relate all those aspects as a risk factor. And if those things happens, then how it will impact the financials. Very important another analysis is a deferred revenue expenditure. We may say the company or finance person are exploring this deferred revenue expenditure as a window dressing also, because there are certain expenditure. Basically, we can't consider that it will have the future utility. Only and only if there is a future utility, then it should carry on it as a deferred revenue expenditure. But those are classified as a deferred revenue expenditure as a future utility, and we may put the note that in the opinion of the management, those have the longer utility for the future, and those due to those aspects we have capitalized into the deferred revenue expenditure, but it may not be the case. So accordingly, in those aspects, we should very cautiously also apply into the startup cases also. So deferred revenue expenditure, if it is put into the balance sheet, then we should actually analyze that whether they carry on the nature of the deferred revenue expenditure or not. Investment carrying low rate of income, because on the asset side of the balance sheet, there may be certain assets other than our core business of that company. So whenever there is any investment in other than core business of the company, then we should analyze vis-a-vis the return of those investment vis-a-vis the ROC of the operating business. Suppose ROC of the operating business is a 15% and company has put any investment into the any other investment or any other business where company is not earning or earning at very low rate or 3%, 4% or 5%, then definitely my entire return on capital employed will reduce on average basis. So it will impact my financial, it will impact my valuation, and there may be also we may consider the risk of those investment itself. Contribution of intangible assets, if we have, it may happen that in past we have acquired any business by paying a very high value, so we debited that balance amount as a goodwill or any brand or any other intangible assets. But definitely if we have paid more than we should have paid at that time, definitely those should not be carried forward. As a financial analyst, we should analyze that whatever the intangible assets are being reflected in the balance sheet dates, whether they have a future value or not, or whether company is appropriately charging off as impairment of intangible assets or not. Performance of the group company, because we know many investments in case of the consolidated and group companies, many investment as a parent company and holding company, they make into their subsidiary company or a group company. So actually it should be seen and analyzed as a very cautiously, because it may be the case of the diversion of the money, and whether those investment into the another company, what is the gain out of those investment? Means there's those due to those investment, whether company is earning any dividend, whether company consolidated financial statement are giving any incremental business or incremental profit, if we compare vis-a-vis the size of those investment. So those should be analyzed. Excess cash than business requirement. Certain time it happens that company may be having the huge cash and cash equivalent. So investors are impressed by seeing that yes, company is very liquid company. It is holding a very excellent cash and cash equivalent, excellent marketable securities. But we should see it as a otherwise case otherwise, because every money deployed either free of charge or idle, it has its cost of own. How cost? Because there is a expectation of return on capital employed. And if as an investor expect that my return on capital employed from certain business is a 15% or 18%, and if those my marketable security or excess cash are deployed as 5%, 0%, 8%, 7%, whatever may be, then definitely it will be very difficult to reach my targeted return on capital employed on average basis. Excess real estate investment vis-a-vis the opportunity cost, luxurious investments. So those are the analysis of the, it may means the items, name item would be more than it also. These only indicative items also only, but we should be, the core objective is that we should be able to analyze the asset side of the balance sheet in a manner that it gives the desired rate of return on capital employed or not. So of balance sheet item, there is a very number of item. It is only indicative list, but if in one line I will say, we should not ignore the off balance sheet items. We should able to analyze the off balance sheet items with the future probable impact on the financial statement. So there is a litigation, there is a contingent liabilities. If it will go the wrong and if it will go against the companies, then how it will impact our financial statement. So those type of analysis should be carried out before you make an investment. As we know, no company, no business is out of risk. So as an investor, first and foremost thing is that you should be able to analyze the risk factor. What is the risk factor with this company? Every company has a risk. We can't say no company is without risk, but whether that risk, whether company is able to meet that risk in future or not, whether company has a plan to meet those risk aspects or not. So, and whether company has an appropriate margin of safety to meet that risk factors or not. Risk may be internal or external risk. In case of internal risk, we may say the operating leverage risk, because we should be able to bifurcate our expenditure as a fixed expenditure and variable cost expenditure. There may be high operating leverage company, there may be low operating leverage company. So in case of growth oriented company, we can say high operating leverage company is better because we have already met our fixed cost. So whatever we will, our revenue will increase, the maximum amount we will generate from the low variable cost, right? Accordingly, financial leverage, and it is rightly said that equity is more costly than the debt. So it is not the case that we should borrow 100% equity or 100% debt. So what is the debt equity ratio we should deploy? It depends on business to business, and where is a financial leverage. Our chartered accountant people can definitely can guide the company in better manner here, because whenever our cost of debt is lower than return on capital employed, then definitely companies should deploy for the financial leverage so it can maximize the earning for the return on equity. But up to what extent those financial leverage should be carried out, it also depends upon the margin of the safety company enjoys. So interest coverage, business model risk, product, technology, the list can be so and so on. External risk, many external risks. Which external risk is applicable to the company? If political risk, if company is driven by the any business which is due to the any political aspect or political connection, tomorrow those party will be if will not be into the government, then definitely the business of the company may be affected. So those type of aspects, market risk, forex, commodity risk, if company consumes any product which is a commodity product, crude oil price risk, so we should analyze all those risks. If we'll go worst, in worst cases, up to what extent it can go wrong and how it may impact the financial of the company, those should be analyzed. So most important part of financial tools uh, we deploy is a ratio analysis. Yes, definitely ratio analysis. If we, by terminology, ratio analysis is we, from our student days, we learn the ratio analysis, how to prepare those ratio analysis, but it is not the case when we do the valuation. As a ratio analysis, it is not about the preparation of the ratio, but it is how you visualize the ratio, how you visualize along with your future financial, how you connect. There should be a connecting dot available. You should connect the dot of those ratios with the valuations, with the financial, with the profit, with the cash flow, with the your risk factor, with your assets, with your liabilities. So you should be able to connect, and accordingly you should be able to reach at the point that how it will impact the valuation. So we will definitely go through the certain key ratio analysis, and again cash flow analysis, very important analysis, sensitivity analysis, because if something will go wrong in the future, then how my business, how my cash flow, how my profit will be affected. So those sensitivity and scenario analysis should be considered as a financial tools. Now, as a financial ratio analysis, we all chartered accountant know that five important aspects needs to be addressed when we carry out the ratio analysis. What are the five aspects? Liquidity aspect, solvency aspect, efficiency, profitability, and valuation aspects. So let me go through the certain key ratios and how it should be interpreted and how it should be looked in when you are carrying out those analysis as an investor. So one important analysis is a sales to working capital ratio. So as we discussed previously, the efficiency of the management is how efficiently it manages the working capital, because it is the working capital which generates the sales. It is the working capital which generates the margin. So we should see most important ratio should be seen as a sales to working capital, or we can say sales to current assets, because in case of sales to working capital, we exclude the trade payable, and this trade payable is a basically not a short-term liabilities, but a liabilities which we are getting without any cost, because we are not required to pay, we are not required to incur any interest cost while when our payable is outstanding. So sales to working capital. Working capital is an investment for us, very important investment. Higher the working capital investment, it has a cost. It has a cost in form of the liquidity, and it has a cost in form of the opportunity cost in form of the ROC and ROE. So whenever there is a cost is involved behind that, we should be able to link it with the sales. And what is the ideal working capital ratio or ideal sales to current assets ratio? I have prepared one example. So let me understand from that example. Suppose there is a net core working capital of say 100 and non-current assets of 100. So for simple understanding, let me say on the asset side of the balance sheet, there are only two items, non-current assets and current assets or net working capital. So 200 is the investment. Return on capital expected by investor is a 15% and expected sales margin is a 10%. These are the four key parameters. Now, on the basis of these key parameters, let me analyze what is the ideal sales to core working capital ratio. So capital employed is at 200. Return on capital employed expected is a 15%. So we may say 30 rupees. To earn those ROC of 30 rupees, what amount of sales we are required to carry out. Now already sales margin is given. Sales margin is given is a 10%. So accordingly, if we say that to achieve the ROC of the 30, we require to have the sales of a 300. Now working capital we can't change the working capital because working capital is a requirement of my business. And now with those requirement, what amount of investment, what amount of sales we should generate, so we can reach the desired ROC of the investor. So in this case, you will be able to see we should have 300 divided by 100 as a sales to net working capital ratio. So whatever investment, net investment we have in the working capital, we should carry out a 300 turnover, 3-time turnover, so we can have the expected ROC of the 15%. If we change the scenario, suppose in this case, the expected ROC is at 20%, that is a 40. So sales to working capital ratio would be 40. If we change the margin, then it will again say, so this example is only given to explain that what is the ideal sales to working capital ratio is definitely depend upon the facts of the business, facts of the industries, expectation of the investors, expectation of total return on capital employed, margins. So those aspects should be analyzed before we reach to any conclusion that what is the ideal sales to working capital ratio. So we can, according this is the logic, we as a chartered accountant, we are not required to, I am not required to explain each and every ratios. How to calculate the ratio is not important. We have understood the logic. We put the logic that accordingly we analyze each and ratio. Let we see that on requisite current ratio, how much amount we are able to generate as a ROC and ROC. Accordingly, all ratio analysis should be analyzed, and then it will be a guiding factor for us that what is the ideal ratio for any particular company or particular industries. Now let again understand the another example of debt to equity ratio. So what is the ideal debt equity ratio? As sales to working capital is a very important, another very important aspect is a debt to equity ratio because it's a case of the financial leverage. Now, what is the total capital employed? So debt and equity. If we put the total of both, it's a capital employed for us. Now, what should be the ideal total debt to the net worth? Again, it depends on the how much ROC it gives to you. So we are linking in each and every ratio analysis, we are linking the ratio along with the how much it generates the ROC and ROE for us. And accordingly, we should decide what is the norms. We should not decide on the basis of the banking norms only that debt equity ratio 2:1 is to 1 ideal or 1.5 is to ideal. Because if sales has a very little margin to generate, then definitely it is a high risk because ultimately our fixed cost is high and margin is low. So debt equity ratio and everything should be analyzed on basis of the ROC and ROE company want to generate. Again, I will put one quick example here. So let me understand it. So debt is 100, equity is 100. So in this case, debt equity ratio is 1:1. Expected ROC is a 15%. Cost of debt, we are analyzing as a cost of debt. So in this case, my capital employed is at 200. Again, my expected ROC is a 15%. So 30 is my requirement. So my expected generation is a 30. Now 30 is a generation of the business as a whole. Now I have to appropriate it for the debt and equity, where my capital, from which my capital, which is my source of capital. So one source of capital is a debt. So in our case, 100 is the debt, 10% is my cost of debt. So if I will appropriate first all, because first of all I have to appropriate the fixed cost. So definitely if I will appropriate it, then 20 would be the balance for me. And that 20 will become a 20% ROE for the investor. So in this case, we may say, what should be the ideal debt to equity ratio is analyzed by putting all these aspects. Suppose in second case, if debt to equity ratio is 2:1, so what is the ideal one? How then in that case, ROE would be the 25%. In third case, if debt to equity ratio is 1:2, then my ROE would be 70.5%. So logic here is that let me connect the dot along with the return on equity and return on capital employed. So our financial leverage planning should be on basis of the cost of debt, expected ROC, debt equity ratio, and total capital employed as a whole. So accordingly, debt service coverage ratio, if you also say debt service coverage ratio, so we can say operating profit EBIT is a margin for entire capital employed. Now I have to pay my principal and interest out of that. So what is the advisable debt equity ratio? So let me again go directly into the example only, because we as a chartered accountant definitely know how to prepare the ratio, but let me understand how we should connect it with our margin and ROC requirement. So in this case, capital employed is 1,000, debt is 500, equity is 500. Debt equity ratio is 1:1, cost of debt 10%, ROC 15%, and let we understand the debt is repayable, for example, in a 5 year. So in this case, my DSCR would be 0.75. Now, if the fact of the business change, suppose if in the above case, I have deployed debt equity ratio is at 2:1, my ROC is changed, then definitely my DSCR would change. So here again, the logic is that let we start the exercise as a reverse way, that first of all identified what is our ideal return on capital employed for the business. When we come to the conclusion on ideal return on capital employed based on investor expectation, based on the market, based on the industry which it belongs, and thereafter we carry out the reverse exercise, and we come to the know that how it connect to the particular ratio and what should be the ideal ratio for that particular business. So all those ratios, debt to core working capital, debt to EBITDA. So purpose to analyze all those ratios are basically risk and rewards. How it connect the return, how it generate the maximum wealth for the investors, and how we can minimize the risk factor, because the risk factor also needs to be analyzed vis-a-vis the earning factor. So asset turnover ratio, inventory turnover ratio, again, the logic is there. We are not going into the how it is calculated, because we as a CA very well know how to calculate all those ratios. Profitability ratio, as we understand, most important ratio is a return on equity and return on capital employed, because ultimately at the end of the day, for the businessman and promoter, invest to earn and to create the wealth. So if there is a ROC, then there is a ROE, and we can maximize the ROE in basis of the financial leverage. So we should be able to calculate and generate how ROC and ROE of any business is there, how it matches the expectation or not, or it vis-a-vis the peer or industry as a whole. So EBITDA margin, profitability ratio, EBITDA margin, GP ratio. Now, about the EBITDA margin, let me give one example, because up to the EBITDA margin, we have is a operating cash flow. Now, we should, and up to that, we are leveraging on the operating leverage. So, fixed cost and variable cost. So, what is the appropriate EBITDA margin? for the particular company, we should be able to also analyze on the basis of the fixed cost and variable cost of any company. If a certain time question will arise that what is the fixed cost and what is the variable cost of the company, how we can come to know, we can come to know along with the growth of the company. So above example explains when the operating leverage is high, once the fixed costs are levered and any increase in turnover will increase the operating profit at more faster rate and vice versa. So there I have given a four important valuation ratio, which is normally being calculated for carrying out any valuation analysis. So one is the PEG ratio. What is that? P ratio to the expected EPS growth rate. So analysts are widely using this ratio. This ratio analyze that any stock is undervalued or overvalued. So when your P ratio, so identified when lower the PG ratio, stock is that undervalued and higher P stock overvalued. If I give example, if my P multiple is 10 and if my expected EPS growth is 10, so I may say that my P multiple is equivalent to the my expected EPS growth rate. So we may say the stock is not undervalued or overvalued. So accordingly, vice versa can be the situation while we analyze. As we know, P ratio is a widely used multiple, but we can say this multiple does not consider the any accounting adjustment in form of depreciation, amortization, deferred tax. So we should not rely only on the P ratio when we are carrying out the any valuation exercise. Like one EBITDA, EV to EBITDA and EV to sales. When EV to sales should be applied, it is very simple to apply when there is any company is a loss making, but there is a business. Because if there is a business, then tomorrow it may happen that company would be able to meet their fixed expenditure. But if there is a no business, then there will not be there will not be any value creation in the future. So simple ratio to apply EV with the sales, because today my sales margin would be low due to operating leverage or any other issues or any initial establishment expenditure. But in future, if there is a sales, then definitely situation will come in the future that my valuation and my profit will grow. So accordingly, EV to sales ratio is being applied. Like EV to EBITDA is not prone to accounting adjustment, but definitely it is value irrespective of the debt level. So it is very important analysis, because if whether company is earning or not, entire company is earning, then it is definitely being measured at the EBITDA level. So entire company earning along with the irrespective of the debt level, we relate it with the enterprise value of the company. So we don't have now time, so I will complete within next few minutes. But I have prepared certain indicative aspects. If we go from start from the profit and loss and balance it, what should be from line item to line item? What should be our analytical point? So we are not going right now into the depth of those aspects due to the limitation of time. So let me go quickly through those. And I think we have already discussed many aspects of those during my previous explanation in the previous slides. So let me give 2 minutes into the one Excel sheet I have prepared. Are you able to see my Excel sheet? Hello? Okay. So I will conclude into this Excel sheet within few minutes only. So I am putting this Excel sheet to the participants only to explain how we carry out the analysis. So in this case, this is the analysis of the textile company. I have taken 6 to 7 textile company. So I have put horizontal analysis, vertical analysis, trend analysis. So I have put the turnover. I have put here company-wise analysis. I put here what are the key factor of any company. So from EBITDA, EBIT, EBITDA margins, let we here see that this company, out of their 100 rupees investment, 62% is deployed in the capital expenditure, property, plant and equipment, PP. So it is highly capital industry. So accordingly, we should analyze our other ratio aspects in those manner. So if we go to the summary part, so here is a growth to turnover. So incremental, we should analyze in a manner that incremental turnover to incremental EBITDA. So in this case, we will see my, in first year, my turnover has decreased by 9.5%, while my EBITDA has decreased by 36.73%. So it's a highly operative leverage company. So from those operative leverage, if you will further drop down, let me come to the EBIT. Thereafter, financial leverage aspects will come into the picture. So let me come into the return on capital employed, return on equity. So these are the ratio analysis where carry out in different manner as incremental sales to incremental working capital, incremental capex to incremental turnover, sales to working capital, sales to capex. We have related it with the valuations also. So P ratios, EV ratios. So most important in these cases, analysis we carry out is ROC and ROE. So let me give one example here in case of the Raymond last 2 minutes only. Suppose in this case, if you will analyze my ROE was 18%, thereafter increased to 24, and thereafter it increased to 70% annualized. So what's the reason? So if we see a reason, my ROE is more than ROC in all the three periods. Debt has increased from 21 to 21, and cost of debt is less than ROC. So every increase will give my incremental percentage in the ROE. So if we can conclude that if ROC is more than cost of debt, then ROE would be more than ROC with the increase in debt and vice versa situation. So all these analysis has been carried out for every company, and you will have insight that what would be the case here. So I think I have carried out up to much extent to within the limited time I have available with me. However, whatever question if any participant have, I can definitely address to it. Hello. 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 Yes, sir.
Thank you so much, sir.
Yes, whether any participants has any questions, then I can address. Otherwise, let me convey thanks to the CP committee for inviting me and to share whatever little knowledge we have among our ICI members. And it is my privilege to be a part of this webinar. Thank you very much for inviting me.
Thank you so much, sir, for your valuable uh, deliberation on this topic. There are no questions has been received from.
Okay, just a minute.
Am I audible?
Yes, I have stopped the. Okay.
Yes, sir. Yes, sir. Thank you so much, Tilpang sir, for your valuable deliberation on this topic of value investing. You have given many insights on the balance sheet, how to read the financial statements for the purpose of value investing. There are no questions has been received from the audience, so I request. Can I start the next session, sir?
Okay, sir. Thank you very much.
Thank you so much. Thank you so much, sir. Thank you so much.
Should I leave the session?
It's okay.
Okay.
Now we are start. Moichi, can we start? Yes, sir. Okay. Uh, After this very fantastic session on the value investing, we are going to start the next session on value of supply under GST by CA Hiren Pathak ji. He possesses a comprehensive understanding of legal and financial aspects of taxation. He has further advanced He has further advanced his knowledge and skills by obtaining the DISA Diploma in Information System Audit qualification from ICI. Regarding his contribution to the field, CA Hiren Pathakji was appointed as a cooperative member of Indirect Tax Committee of ICI New Delhi for the year 1819. He has delivered insightful lectures on GST at various professional forums. So I request CA Hiren Pathakji to start his deliberation. Thank you so much, sir.
Thank you, Sagar bhai. Am I audible?
Yes, sir. You're audible.
Okay. At the outset, I would like to thank Purushottam ji, Chairman of the CP Committee, Gyan Chandra Misra ji, Vice Chairman of the CP Committee, and Silpang ji for wonderful deliberation on the previous session. The topic has been allotted to me is valuation under GST. Uh, I will try to cover as much as possible within 1 hour. The time that has been allocated to me. The topic itself is very vast topic, but I try to highlight important part or important aspect of each provision. So I'm sharing my screen. Screen is visible. Okay. So, as I said that today's topic we will discuss various provisions under value of supply. In that we will broadly cover these points. I think the slide is moving, right? You can see the next slide. Hello. Topic to cover slide is visible on your screen, right? Hello. Okay. So, okay, fine. Thank you. Thank you for the confirmation. Broadly, we will try to cover various aspects under value of supply, wherein our first point is how we determine the transaction value. Because we all know under GST, unlike previous regime, we don't have the abatement scheme, we don't have the MRP based valuation. More or less, the valuation under GST is being governed by the transaction value. So we will broadly understand what are the value or how do we determine the transaction value in case of a supply of goods or supply of the services in under various scenario. Then after, as such, one would say that the transaction value is the value under GST. However, there are certain inclusion and exclusions to that transaction value. We will determine and we will go through individual inclusion as well as exclusions under GST, and what are the conditions that needs to be fulfilled to consider any transaction value as the value of supply. Because if you determine that whatever price that you are charging to your customer, that becomes the value of supply if you fulfill the condition provided under the law. However, in case the conditions are not fulfilled, then you have to value your valuation as per valuation rules. Valuation rules is very broad compared to the valuation which is provided under the act. We will go through various valuation rules which talks about different provisions under various scenario. There are also specific valuation has been provided like money changer or foreign currency sale. There are various types of valuation mechanism for separate class of person that we will also go through. And most important part, if I talk about the value of supply, then I think that discount is the prominent part, which is I believe most litigation would arise under the value of supply because of the terminology discount. Because the moment you are identified something as discount, you are about to reduce that particular portion from the value of supply, and accordingly your tax payable amount would get reduced, and that cause the root problem for the litigation. So we will also determine what are the implications for the free supplies and what are the implications for the discounts, and ultimately we will go through the key takeaways. I would say that before jumping to the topic, I would say that the valuation mechanism is very important from the viewpoint of business, wherein various business strategy would depend on the valuation. Had it been the case that you have determined certain SOPs for particular transactions, wherein you have the contracts with your customers or the suppliers, and various conditions and various factors mentioned in that contract will also have the direct impact on valuation. We will see that in detail in the subsequent slide. So first we understand the valuation concept, that what is the value of supply. To connect the dot with the supply provision, because we all much aware about the levy provision which is there under the supply. Levy of supply is provided under section 9, which says that subject to provision of subsection 2, there shall be levied a tax called CGST or SGST, as the case may be under the different provision of the act. It shall be tax shall be levied on the all intrastate supply or the interstate supply, as the case may be, except obviously on the supply of alcoholic liquor for human consumption on the value determined under section 50. See, valuation under GST is provided under section 15 itself. It is only one section provision. However, it is very detailed, and implication of each provision is very detailed. Value determined under section 15. On that value, you are supposed to pay tax at the rate which would be determined as per the rate schedule, and the same needs to be collected and paid as provided under section 9. So this is the levy provision wherein the reference of value has been provided. So we need to determine the value on which we are supposed to pay tax. So the concept of the valuation concept is like that. You need to determine the value of supply, and you need to determine the applicable rate that is provided under the rate schedule. Accordingly, you are coming for the outward tax liability that you are supposed to pay for any transaction considered as supply. So this is the thing that we need to discuss. So how do you determine the value of supply? As I said that value of supply is nothing but the transaction value, provided you fulfill certain condition. And what are the conditions that you can see on my screen? That valuation to be done in the manner only when all the conditions are met, and the conditions are two. First condition is that supplier and recipient should be unrelated, that is, they must not be the related party, and price is the sole consideration for the supply. If you fulfill all two conditions, then the transaction value would become your value of supply. However, as I said, there are certain inclusions and exclusions. Inclusions are provided under section 15.2 and exclusions are provided under section 15.3. So accordingly, you are determining the value of supply. The moment you determine your value of supply, you need to calculate rate applicable for that particular goods or service, and you will determine the output tax liability. So this is broadly the concept of valuation is. We will go to in detail. First, we will discuss that what if the conditions are met. As I mentioned over here, if the buyer and seller are not related, and the price is the sole consideration, I mean there is no any other benefit which is which gets due to the supplier, and it is without any price is only the consideration, there is no any other monetary benefit, monetary or non-monetary benefit that is being passed on to the supplier, then you just need to determine the value of supply based on the transaction value only. However, if the conditions are not fulfilled, then as I said, you need to go to valuation rules. So we are discussing what if the conditions are fulfilled, then we are not supposed to go to rules. We just need to focus only on section 15, subsection 1, 2, and 3, which provides the valuation mechanism that we will see. So what if the conditions are met? If the conditions are met, then as I said, the transaction value plus there are certain exclusions minus certain exclusions plus certain inclusions minus certain exclusions becomes the transaction value, and that is the price paid or payable for the supply of goods. That means if there is no further inclusions or exclusions in uh, the transaction value, then whatever value that you have paid, I mean that you have quoted on the invoice, that becomes the transaction value, and that becomes your value of supply. However, as I said, the important point to note over here is that in this case, it must be noted that all the conditions are met, and if the conditions are not met, then we have to go to valuation rules. Now we see that let's take an example that you are raising the invoice to your customers of rupees 100 and you are charging 18 rupees as GST. So if there are no further inclusion or exclusion, then that 100 rupees become your transit value of supply. However, you need to assure that these following of 1 2 3 4 5 items are not inclusion. If at all, if 1 2 3 4 5 items is applicable in your case, then on that 100 rupees you need to add certain value. What are the inclusions in the transaction value, that we will see in detail. So section 15.2 determines that there are certain inclusions. First, any tax, duties or sales fees by whatever name called under the any law in force other than GST if charged by the supplier. Let's say supplier is charging certain local tax applicable in that particular region. Let's say some local tax that he is charging, but that should not form part of GST. Let's take a case where some entertainment tax which got subsumed, but similar sort of tax which is locally prevailing in that particular region, and that tax has been charged by the supplier, then on that value, on that sales or the tax also, price should be GST should be paid. That means your transaction value should include that sales fees or tax or duties as the case may be. Second point is very important. It says that the amount that supplier is liable to pay but incurred by the recipient. If you break up this part, then it says that supplier is liable to pay. So first thing is that one particular transaction, let's say you have a contract with your customer, and I mean you have a contract with your supplier. Any charges that supplier needs to pay, but that has been incurred by the recipient, and supplier has not included in the invoice that he has raised. I'm giving one example to better have the clarity on these particular points. Let's say you are supplying the goods to your customer, and you have a contract that transportation will be on the part of supplier. Now, due to some factors, it may possible that the supplier is not charging that transportation or freight portion to the recipient, but recipient incurred that freight amount or the transportation amount himself. And obviously, since the supplier has not paid that amount, the supplier is not charging that amount in the invoice. Still, since as per the contract, the supplier is liable to pay, but that portion has been incurred by the recipient, and supplier has not included in that particular portion in his invoice or the value. Such portion will be added to the transaction value, and supplier has to pay tax on that particular portion also as per section 15.2b. I hope that is clear. We go to the subsection 15.3c. It says that any incidental expense, including the commission, packaging charges by the supplier to the recipient, and any amount charged by the supplier in respect of supply, that is before or at the time of delivery of the goods. So whatever it says that supplier is obviously charging something in the invoice, but over and above, he is charging additionally like packing charges, commission charges, incidental charges. All such charges will form part of the value of supply by the supplier, provided that he has charged at the time or before the delivery of the goods since it is inclusive, it should be included in the transaction value, and supplier needs to pay GST on that particular portion as well. Fourth point is that any interest or late fee or penalty for delayed payment of consideration. It may so happen that when supplier is supplying goods to recipient, and as per the contract, the recipient is supposed to pay back the amount of consideration along with tax within certain period. If there is a delay, then supplier is charging interest or late fee or penalty, as the case may be. Then that portion is also to be included in the value of supply. Now the question may arise that supplier has already supplied the goods, supplier has already paid the tax on the invoice that he has raised to the customer, but that additional consideration in form of interest or late fee or penalty is being received or is being charged from the recipient later point of time. So how to add the value on, how to add the value for that particular portion in the invoice which has already been raised. So here let me clarify, it is not necessary that on the invoice it has to be added whenever the interest or late fee that is received by the supplier, because the time of supply in such case would applicable only when the supplier received that amount. So obviously that would be at a later point of time. Whenever the supplier received that particular portion, at that time, amount needs to be added in the value, and rather on another way of saying that on that portion, supplier needs to pay GST. Uh, Fourth point, which is the subsidy directly linked with the price, but excluding the subsidy provided by the government, central government or the state government. If any private party subsidies are there, then that should be included. Hope I believe that inclusive part, that is what are the inclusions to the transaction value, 1 2 3 4 5, I clear are clear to you. I have quoted few examples also for easy understanding on a later part. Now we will discuss the exclusion part. We have discussed principally that any tax if charged by the supplier other than GST, that needs to be added. Any tax, any portion of the amount that supplier is liable to pay but incurred by the recipient, that is also to be added. Incidental expense, interest, late fee, and subsidies, that these all five parts which needs to be added to the value of supply. However, there are few exclusions also, which is predominantly discount only. The discount is provided under section 15(3). It says that discount either can be provided to the customer before or at the time of supply, or discount can be provided to the customer after supply. So we divide the discount part into two way. First is uh, pre-supply, and second is post-supply. Pre-supply or at the time of supply, if the discount is provided, then obviously that discount needs to be added in the invoice. That means the invoice value contains the discount portion, and accordingly your total invoice amount will be reduced to the extent of that discount. So one would say that the moment you have any discount on the face of the invoice, that obviously get excluded from the transaction value. Hence, that discount is obviously not included in the transaction value, and you can have the exclusion from that part. Or another way of saying is that on that part, GST need not be paid. However, the debate would arise on the second part, which is the post sale discount. You can see that due to many industry trade practice, we are offering various trade discount in the name of volume discount, target achievement discount, which is obviously the post supply discount. The moment your customer procure certain XYZ quantum of the goods in terms of percentage or in terms of the value, then in at that time the discount is being offered. Whether that discount needs to be excluded from the transaction value or not has been provided under section 15(3). I request you to read section 34 also together with section 15(3) for more clarity, because such post sale discount is being provided by way of a credit note. and credit note has been provided under section 34. The provision of credit note has been mentioned in section 34. What the post sale discount provision as per section 15.3 says about? It says that the discount given after the supply has been effected, that needs to be excluded, provided that such discount is established in terms of the agreement entered between into at the time or before the supply, and specifically linked to the relevant invoice. And third point, ITC attributable to the discount has been reversed by the recipient of supply. Let me give the clarity with respect to this provision in the simple way. It says that three condition needs to be fulfilled, then only you can have the deduction of post sale discount. First condition is that it should be agreed at the time or before the supply. That amount or the percentage of discount that you are offering to your customer, that needs to be agreed at the time of supply itself. You cannot determine post facto. I mean, after the supply, you determine that XYZ amount needs to discount that you are supposed to provide to customer. That is not the discount which is eligible for deduction from the time transaction value. First condition. Second condition is that it should be specifically linked to the relevant invoice, because the discount ultimately that you are offering to your customer, the same discount that has to be linked to the original sales invoice that you have raised to your customers. So it may possible that the one discount can relate to the multiple invoice, but you must have the reference to the relevant invoice against which the discount is being offered to the customer. And third condition is that to the extent of that discount portion, your recipient must have reversed the ITC, because at the time of sale, he must have claimed the ITC on full value. Now you are deducting that particular value from your transaction value. That means you are reducing your value of supply, and accordingly you are paying less tax to that extent. Then obviously your recipient also needs to reverse the ITC to the extent of that particular discount. Hope these 3 points are concerned. Hope these 3 points are clear. Uh, I have also provided below that points for consideration, that for your clear reference. I believe that this is the most complex and the most important section as so far as the value of supply is concerned. What are the points that businessman needs to consider while deciding the policy for the discount? Whenever you are deciding any discount which is post sale discount, then you need to determine whether your discount is discount as per section 15.3. If the condition gets fulfilled, then you are eligible to provide the GST credit note. Until and unless you don't fulfill all these conditions, you cannot provide the GST credit note. Had it been the case that you have fulfilled all the conditions, then you are issuing the GST credit note to your customer, and accordingly you are taking the tax adjustment. In another word, you are paying less tax to that particular portion, that is the discount portion. What if the conditions are not fulfilled? It may possible that there are few conditions which are not fulfilled. Then in that case also, you can issue the credit note to your customer as a business prudence, but you cannot issue a GST credit note. That you have to issue a commercial credit note. And hope that this provision is clear to you. So these all are the examples of section 15.2 and 15.3, which is the exclusion and inclusion part to the transaction value to arrive at the value of supply. It may possible that you are supplying something free of cost. Then what is the provision under GST? Uh, as I said, if I refer to section 15.2, it says that when an amount that supplier is liable to pay but incurred by the recipient. So there it may be possible that the recipient is itself providing something free of cost to the supplier for execution of that work or for execution of that supply. So in nutshell, due to limitation of time, I am highlighting the main point for this FOC supply. It says that if the contract is only to supply the final goods, say along with the construction service, let's say free material, steel, cement, etc., is supplied and also included in the scope of the receiver of the supply, then there is no question of adding that value to determine the transaction value. The question of adding the value of supply would arise only in case where something was in the scope of supplier but has been provided by the recipient. If something supplier itself is supposed to pay or supposed to provide at the time of supply, then it is not considered a FOC and valuation provision would not be triggered. One can refer to circular 47 in case of a job worker. Generally, it happens that the molds, jigs, dies, etc. are being provided free of cost to the job worker by the supplier because supplier wants specific type of goods to be processed by the job worker. Then the value of that mold, dies, etc. are not to be added in the job work charges that is being charged by the job worker to the supplier. This has been clarified under circular 47. And as I said, that discount, which is very important part, for more clarity on this particular discount, when once I said that the primary discount or the secondary discount, depending on the fulfillment of the condition, one can refer to circular number 92. It very categorically said that when you can have the GST credit note or when you can have the commercial credit note, when it considered that you have fulfilled the condition and when it can not be considered as a the condition has not been fulfilled. It circular 92 also talks about various sales promotion scheme which generally FMCG industry is used to. It also talks about various tax proposition in case of such kind of uh, secondary sales promotion scheme like buy more get more, volume discount, secondary discount, or in relation to gifts. Few of the example for your reference. I believe that this PPT might be shared with you. You can have it at your convenient time. Reference from the same, you can take it. Let's say if the commission has been charged extra by the supplier, then that commission needs to be added. Similarly, in case when the interest has been charged by the supplier to the recipient, that interest is also needs to be added, and value of supply for in the hands of supplier will be added. So so far we understand that when the conditions are met, our first discussion was that the buyer and seller are not related and the price is the sole consideration. Then in that case, uh, we are not supposed to go to valuation rules, but we will stick to section 15 only, which talks about the transaction value plus certain addition minus discount and becomes the value of supply. Important point I have already highlighted here for your ready reference. Now we are moving to the second part. Due to limitation of time, I will only discuss the few important rules that we need to discuss. Let's talk about the case where either buyer and supplier are not related and uh, buyer and supplier are related, or there may be a case where the price is not sole consideration. So in this case we are not fulfilling the condition, so we cannot go to the transaction value and determine our value of supply. We have to go to valuation rules. Valuation rules for the each specific situation has been provided, and general rule has also been provided under rule 27 to rule 35. Sorry. Okay. So our first rule is rule 27, which says that what if the whole consideration is not in money? As I said, that the first condition is that the price should be sole consideration, but it may possible that the recipient is providing something in money and something not in money. Then what would be the case in such kind of scenario? It says that for in such kind of scenario, first you need to determine the original market value. What is the original market value that you need to determine? And on original market value, you are supposed to pay tax. Actually, I am facing some technical difficulty. Hope my screen is visible. I am facing some disturbance in my visibility of screen. Okay, fine. Thank you. So here, as I said, that whenever the price is not wholly in money, then first we need to determine the open market value, and we need to value our supply based on the open market value. But what if the open market value is not available? Then in that case, we need to determine sum total of consideration in money plus equivalent amount of consideration not in money. That both values should be added, and accordingly we need to determine that what is our value of supply. However, it may possible that still the same is not ascertainable. Then what if, how to value for such particular transaction? Then it says that the third option you need to opt is, you need to determine the value of the like goods, similar goods. What is the value of the similar goods that has been supplied, and that value you need to take. And if at all that value is also not determinable, then you need to determine the value based on the cost plus equivalent amount of money that you have received. For your easy reference, I have quoted one example. By that, you are very clear about the point that rule 27 is discussing. Let's say you are purchasing a laptop, but against that you are giving your printer as a barter. So let's say Mr. Y supply the laptop to Mr. X. The open market of value of that laptop is not known. Let's say it's very new laptop or some unique laptop is there. The open market value is not available. Then what happens that Mr. X barter the laptop with the printer 5,000. He pays. He gives back the printer which valued 5,000, and also pays 35,000 to the supplier of laptop. Then as per rule, as you can say, the open market value is not available, then money plus equivalent consideration in money. The money is 35,000 plus equivalent consideration in money, that is the price of the printer that has been provided, which is 5,000. So 35 plus 5,000 is equal to 40,000, would be considered as the value of supply for that laptop, and Mr. Y needs to pay GST on that 40,000. Rule 28 talks about the valuation in case of a related party. So this is also one of the important part, I would say, that most important rules, because generally we can see that valuation has been adjusted for the related party transaction, and that's why government is also regularly expecting the taxpayer to declare the transaction with the related party in the financial statement, and also more focused about the valuation in case of a related party. Similarly, this rule is also applicable in case of a distinct person. We all know that distinct person is the person having the same PAN but the another GSTN. So in case of a transaction between the related party, the provision is almost same. First, you need to determine the open market value. If open market value is not available, then you need to determine the like, kind, and quality of that particular similar goods. That is the value that you need to adopt. If that is also not available, then you need to determine the cost, considering the 110% of the cost of manufacture. We will see that cost based valuation rules is also there, and still the same is not determinable, then the reasonable means consistent with the accounting principle. That is the mode that you need to adopt. One important change from the last year, that is with respect to the corporate guarantee. We all know that a corporate used to provide the guarantee to the banks and financial institution for the successful security in form of a corporate guarantee. So till now there is no provision in the law, but the new rule sub 28(2) has been added, which says that the value of supply of service by the supplier to the recipient, who is the related person, by for providing the corporate guarantee to any bank or the financial institution, shall be deemed to be the 1% of the amount of such guarantee offered. So irrespective of the transaction between the corporate, either 1% of the guarantee offered or the actual consideration if they have obtained. Generally in corporate guarantee the consideration is not being offered, but had it been the case that consideration has been offered, then 1% of the corporate guarantee or actual consideration, whichever is higher, on that GST needs to be paid. 29 talks about the value of supply through agent. Generally, in such kind of scenario, when agent is supplying to third party, then it may possible that the 90% of the value the agent is supplying to the third party, that is the value when the supplier can take while supplying the goods to the agent, or the market value, whichever is higher, that at the option of the supplier, that value can be adopted. Miscellaneous provision I am not focusing on due to the limitation of time. I have provided the discussion points over here. You can refer it at your convenient time. Some of the important part and changes that has been recently incorporated in the valuation is with respect to lottery, betting and gambling. We all know that industry is very hue and cry with respect to this industry when the government imposed the 28% tax on the face value itself. That includes the lottery, betting, and gambling, along with casino and online gaming. This rule 31.3a, 31.3b, and 31.3c has been added, which says that the 28% on the face value that needs to be paid, that is to be considered as a value of supply. In case of online gaming also the same is the case, irrespective of the any sort of transaction, but the total amount that you are paid or the payable to the deposit or supplier for such kind of virtual game or the online game, that is the value that needs to be determined for the taxing this particular transaction. However, the important point to note over here is that in case you win the game and such amount, let's say the winning reward has been returned to you by the supplier, then also that value should not be deducted. The amount that you originally paid to the supplier for that gaming, on that value itself the supplier needs to pay tax. And similarly, in case of the casino also, whatever the token or chips or coin or ticket that you are paying, value that you are paying for that particular transaction in the casino, or in case you are participating any event or scheme competition by whatever name called, and whatever amount that you are paying to the supplier, on that value, it's on that portion itself, the total tax needs to be paid. Generally we were under that impression that only on the margin that tax needs to be paid, but government has made it categorically clear that only on the total value GST needs to be paid. Over here also, even though you, let's say you won in the casino in one particular game and the supplier has uh, return, I mean provided back that amount to you, that also will not be deducted from the valuation, and on total value itself your valuation will persist. There is one rule with respect to second hand goods. It may possible that there are few suppliers who are engaged in the second dealing in the second hand goods. For that the provision has been mentioned in rule 35, which says that those kind of suppliers who are engaged in buying and selling of the second hand goods only, and it may possible that such supplier do some minor processing, but important point to note over there is that such minor processing does not change the nature of the goods. Then what should be the value of supply? It says that the only the margin on margin they need to pay tax, and the margin will be considered as the value of supply. If the margin is negative, then it shall be ignored. That means if a supplier is selling at a loss, then no tax needs to be paid on that particular supply. This pure agent service we are referring to since service tax era, and this is equally important in GST era as well. First of all, we determine the definition of the pure agent, which is the similar sort for as was provided in the service tax era. The pure agent means the agent who enters into the contractual obligation with the recipient and to incur certain expenses during the course of his service. Pure agent does not hold the title as has been provided earlier, and obviously he does not use for his own interest any such goods or services what he has procured. And most important part, since it is a pure agent, he is not claiming any margin. The only actual amount that he has paid he is receiving from the recipient. So in case of a pure agent, tax it's not payable on that particular services which he has procured on a basis of the pure agent. I have quoted one example. If legal services has been provided by the consultant and ROC fees has been paid by the firm which gets reimbursed by the recipient, then on ROC fee tax needs not be paid because supplier has paid that ROC fee as a pure agent. Similar provision is that, but important part to note that such pure agent concept is very crucial. You need to determine and look at the agreement very minutely whether that first pure agent pure agent definition that service must be followed, and then the condition that has been mentioned in rule 33 that needs to be fulfilled to consider the service as pure agent. So if I summarize the discussion points with respect to various rules that we have discussed, when I just brief you within 2 minutes. First, we discussed that price should be the sole consideration, and buyer and supplier should be buyer and sellers, supplier and recipient should be uh, unrelated party. Then you just need to go through the transaction value as value of supply. There are few inclusions as well as exclusions to derive at the transaction value. However, it may possible that uh, buyer and seller are buyer supplier and recipients are not related party. Then in that case, or the price is not the sole consideration, then in that case you need to determine the value as per valuation rules. Related party definition as per GST law can be different with the related party definition as provided under Income Tax Act or any other act. So whenever you are referring to any related party transaction, please refer the related party definition as provided under section 15 of GST Act. There are various mechanisms provided, and you need to equally apply the most relevant rules that is applicable to you. It may possible that you are parallelly two provision or the two rules may be applicable to you. Let's say your related party is also there and agent is also there, then in which in this case whatever the exact application of the rules that is dedicated for your transaction, that you need to follow. And if I conclude the session by the last slide by highlighting the key takeaways during the session, that first, transaction value, as I said, if the condition is fulfilled, then transaction value. If not fulfilled, then we have to go rules. In rules there are various conditions has been mentioned like open market value or like kind and quality. It is also a case where you cannot determine the value open market value or like kind and quality. Then cost method is also there. You need to determine the actual cost, and 110% is the value that you need to adopt in case you could not derive at the transaction value by opting for the other option. As I said, there are few inclusions also, that is 125 section 15.2b, that you 15.2, that you need to go through and check. Even though the conditions are met, but still it may possible that certain inclusions can be applicable to you. And similarly, exclusion part, discount can only be excluded provided you fulfill the all the conditions as has been mentioned. First condition that we discussed, that it should be pre-agreed at the time or before the supply. Invoice linking should be there, and recipient ITC reversal should be there. For to determine and to assure that the recipient has reversed the ITC, you can have the communication or the cross ledger from the recipient by highlighting that he has reversed the ITC, and then only you can reduce from your output tax liability. And in case of a free of cost supply, we have already discussed that the scope needs to be discussed under whose scope the that free supply would be at par. If it at all such kind of free supply is included as per section 15.2, then it may possible that value of that free supply can also be added in the transaction value. So I think with this, I concluded my session. Due to limitation of time, I may not cover all the rules, but broadly, I have covered important and major rules that is applicable for the value of supply. Yeah, over to you, sir. We can have the questions if the participants have.
Sir, just a minute, sir. Just a minute. Question. Am I audible, sir? Yes, sir. There's one question, sir.
Yes,
Freight
sir.
charges incurred by supplier on outward supply, whether it is to be included in value of supply when it is not mentioned in the invoice.
Sir, in that case, as I have mentioned, that first you need to determine that freight charges and is under which whose scope. If the supplier itself is having the scope that he will supply the goods to the recipient and freight charges needs to be incurred by the supplier, and supplier has incurred that, then that should not be included. Section 15.2 discuss about the case where the supplier it is the responsibility of the supplier but incurred by the recipient, then only that needs to be added. But in the given example, I believe that that is the scope of the supplier itself, the freight charges he has to bear. So he must have included the freight portion in the price of that particular product that he is charging to recipient. So in that case, it should not be added.
Okay.
Hope I clarify your answer.
Okay, sir. Then amount that supplier is liable to pay but has been uh, paid incurred by recipient and reimbursed from supplier. In this case, the recipient has to pay GST on freight under RCM since
uh,
please.
no See, one thing you need to one point that you need to clear over here is that this provision talks about the inclusion in the transaction value. Now
Hmm.
the inclusion in the transaction value, that means the transaction value means the invoice value which have already been raised to the customer. Now when the supplier has already raised the value to the customer, now the provision talks about the case where supplier also needs to pay more tax over and above the invoice value, wherein he must have charged 100 rupees, but the freight portion which originally agreed by the supplier but which has been incurred by the recipient, on that portion also the supplier needs to pay tax. So here the view, here from the supplier's point of view, he needs to pay tax on that particular portion. So far as the recipient is concerned, if recipient has incurred the transaction, if recipient has paid the freight amount, he's obviously gonna pay RCM on that particular freight portion, because that is the inward supply for the recipient, because supplier might have paid the tax directly to the transport company. So supplier needs to pay RCM. That is altogether a different thing. It is from the supplier point of recipient needs to pay RCM on the transportation charges that he have paid to GTA. I am on the point of the supplier that on a notional value that he needs to determine, and on that value supplier also needs to pay tax based on the section 15.2b.
Sir, in case recipient has incurred but reimbursed by the supplier, it means it is been borne by the supplier itself, right?
No, reimbursed by, okay, reimbursed by the supplier. That means that is already reimbursed. It is not covered by the case. So so let's take a case when supplier has, it is the duty of the supplier to incur the transaction, but he has been incurred by the recipient, and
Right.
subsequently recipient is claiming back that amount from the supplier.
Yes.
So
Yes.
in that case section 15.2b will not trigger. The reimbursement portion is altogether different thing, but since the RCM is to be paid by the person who is paying to the supplier, paying to the GTA, and since in this case the recipient is already paying to the GTA, even though it is recovering from the supplier, but RCM liability will trigger to the recipient only. So recipient will continue to pay on the payment to the GTA. Hope that is clear.
Okay, 1 minute, sir. Another question is there. Forex difference credit received by the recipient of
Yeah,
the
sure.
goods. Do the recipient needs to reverse the ITC on forex difference?
No. Forex difference is not the value that is to be added or deducted from the valuation of supply. It is due to the fluctuation part only. He is getting extra amount. Generally, I forgot to highlight one slide which is also there and discussing about the case where in case of a cross border transaction, what is the value that you need to adopt. So generally, in case of a supply of goods, you need to take the CBIC rate as the rate for deriving the value. Let's say you are raising the invoice of $1,000. So how do you value $1,000? So in that case, it says that $1,000 multiplied by the CBIC rate in case of supply of goods. So far as the supply of service is concerned, you need to take the rate of generally accepted accounting principle. So what, let's say RBI rate or whatever the continuously that you are accounting the rate in your books of account, that rate you need to take. Now let's take a case that once you book that amount and differential portion you are receiving, so that will not be included in the value because you have already determined the value at the correct rate as prescribed under the rule.
Okay. Can I take next question, sir?
Yeah, sure.
Okay. Uh, can an assessee providing services issue credit note for cancelling the original invoice as the company is not accepting the invoice due to calculation mistake? I think answer is yes.
Sorry, I cannot relate to credit not issued for original invoice.
Uh, Due to calculation mistake in the invoice,
No.
recipient is not accepting the invoice. So can he issue the
Yeah, so
credit note
calculation.
for that?
So first, so as I said that whenever you are referring to section 15.3, you need to refer section 34 as well,
Mhm.
wherein it is mentioned that the scenario under which you can raise the GST credit note, under which the first scenario is that the taxable value or the tax might be charged extra. So
Mhm.
in that case, the differential portion can be routed through the credit note, GST credit note. Now, so far as your recipient is not accepting that credit note is your internal issue, I would say business call, whether you go through GST credit note or the commercial credit note. But so far as discussing about the legal requirement, yes, calculation mistake, in case of a calculation mistake, you can raise the credit note with GST.
Mhm. Yes, sir. Thank you so much for your deliberation, sir.
Yeah,
You have given a
thank
lot of
you.
time, and thank you all the participants for
Thank you.
patience hearing.
Thank,
Yes. Yeah, I also thank CP committee and the chairman and vice chairman for having me here as a moderator. With the permission of chairman and vice chairman, I declare this session to be as completed. Thank you so much.
thank you. Thank you so much.
Thank you so much. Yes, sir. Yes, sir. Thank you. Yes, sir. Thank you.